Hello, everyone. Today on the Final Bar, my guest is Samantha LaDuc from LaDuc Trading, helping us think about U.S., non-U.S. Stocks, and particularly thinking about the dollar and what the direction of the dollar means for your investment portfolio. We're also going to answer some of your questions from the Final Bar Mailbag. We have a day that started strong and then sort of ended in a position of weakness, so a bit of distribution there. While we have a lot of people speculating on the reasons, we're going to focus on the charts. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close. Look at the day's trading, the day's activity through a technical lens. Try to connect today's themes with the longer-term structure of the market. Try to be on the right side of things more than we're not. And leading up until today, we've had this sort of yin and yang, this push and pull between two, I think, primary outlooks for stocks. Either we are recovered and recovering aggressively, and we have a lot of further upside as the world starts to reopen, sort of quote unquote get back to normal, or this is the final gasp of a bear market rally, and we're beginning to see further downside. You know, what's happened in the last week or so, I feel like somehow has validated everyone's opinions, and it's funny. If you're bullish, you are finding lots of reasons to be bullish. If you're bearish, you're finding plenty of reasons backing up your bearishness, and it is confirmation bias run amok, to be honest with you. We'll get to a little bit more of that when we get to our market recap. I did want to point out some of the guests we have coming up on this show and elsewhere on StockCharts TV. Today, as I mentioned, a great guest, Samantha LaDuc from LaDuc Trading. Tomorrow, we have Jonathan Krinsky from Baycrest Partners in New York. And then on Thursday, Clint Cowles from TD Ameritrade. Next week on this show, we're going to have Roman Bogomazov on the 12th. That's next week. And Roman is an expert in Wyckoff analysis. Really interesting time to look at that because I think the methodology jives pretty well with what we're seeing. Also on Monday, our next episode of Behind the Charts features Keith Fitzgerald. Keith actually splits his time between the U.S. and Japan, but lives not too far from StockCharts HQ here in Washington State. And Keith's a fantastic strategist, thinker about the markets, and thinks about how you think as an investor. So it was a really fun conversation with him that we'll share with you on Monday. Coming up next week on the 13th is our next episode of The Pitch, featuring three experts pitching you their ideas for investing for the next couple weeks, next couple months. It should be a really cool conversation for The Pitch on May 13th. Let's get to our market recap. So as I mentioned, confirmation bias, if you're not familiar, is essentially where you have a preconceived notion of where you think things are headed. You have a conclusion you've already made in your head. I am bullish or I am bearish, quote unquote. And then as you start to look at information, you start to gather information and essentially just reaffirm your preconceived bias. So if you're bullish, any evidence that supports your bullish outlook, you feel you attribute greater value to that, and anything you see that disagrees with your bullish outlook, you sort of mentally push it aside. And all you've done is already made the decision, and then the evidence that you gather doesn't help to change your opinion. It just helps to further dig in your heels and focus on your point of view. In this sort of environment, I would argue it is never a good time to have that as part of your process, but now more than ever, it's important to have an unbiased, clear look at what you're seeing around you and try to make sense of it. And the reason why I'm saying that now is because, as I mentioned in the introduction, what concerns me is that anyone that I've talked to, people that are very bullish, I've talked to guys that like Craig Johnson saying the S&P is going to go to 3,600 by year end. I've talked to guys like Jeff Hughes that say that the S&P is going to make new lows in the near future. And so how can we all have that opinion? Well, the reason is because we can find evidence that backs that up. And so I think as a trend follower, it's important to pay attention to the charts and where they're evolving. So let's get to that now. The S&P was up pretty significantly, teasing the 2,900 level, which would have been an impressive kind of jump on the way to that S&P 3,000 level. Big round number, the 200-day moving average, a lot of sort of resistance there, expected resistance there. but we sold off into the close. And so a bit of distribution. Well, we had accumulation going into the close yesterday, which felt pretty encouraging on the positive side. And the gap up this morning certainly felt like a follow through. We actually closed below the open. We got down below 28.70 to finish around 28.68. So it's just below 1%, still finishing in the positive. If you look at mid caps, about the same, up a little more actually. Small caps up just 1/3%. So it's definitely more of the large and mid cap stocks that led the way higher. The VIX a little lower now, just below 34 now at 33.64. Looking at other markets, bonds actually finished weaker. They gapped down pretty significantly. Looking at the TLT, came up a little bit, but still down about 2/3% for the TLT, down to 166. The dollar in the form of the UUP up a little bit, but is really more of a flat day for the US dollar. Gold finishing actually pretty strong. Opened the morning lower, but actually finished in a position of strength. Again, we talked about the long-term chart of gold being a pretty compelling long-term option. If just in case you find yourself thinking all I need to do is follow oil prices and I'll know what energy stocks are going to do, hopefully this day disconnects those a bit. The USO is up almost 10% today, but energy stocks flat for the day, up 0.1% on a day when the S&P finished up almost 1%. Commodities as a complex, the DBC was up 2.5%. Let's look at the chart of the S&P 500, then we'll get to some of the other themes that we saw today as part of our market recap here. So, again, on the daily chart of the S&P, we spent a lot of time talking about this chart. And just to reorient you, we, by any historical measure, I was talking to my friend Tony Dwyer this morning, and he asked me if I was still in the, retest the lows sort of camp. And I am. It's become harder and harder to do this because we've rallied so strongly. But in some ways, behaviorally, I think that keeps validating it, because the mark of a good bear market rally is it sucks everyone in. When you can't imagine that we would go back and retest the lows. That seems to be when it happens. So if you look at historical parallels of deep bear market phases, extended bear markets, this is what the first leg tends to look like. Now, I'm not saying it's absolutely going to go down, even though I think that's where the evidence is going to point us. In the short term, we continue to make higher highs and higher lows. That is undeniable. That is fact. However, it's just this is looking like a lot of bear market rallies. That first reaction after the big sell-off before you have the next leg down. So this week I think is pivotal as we finally last week reached the 61.8% retracement, just below 2950. We're right below the 200-day moving average, the 3,000 level, big round number. And now we've had a sort of a first short-term bounce lower. Today looked like it was going to be further upside, finishing around 2,900, but we're actually down more toward the low. So this looks less like a constructive day and more like a digestion day as we finish more toward the lows. I think tomorrow and the remainder of this week will be pretty key. And for me, I think now that we've bounced off of that 2,800 level, that's a pretty good short-term level. And below that, it's the lows from couple weeks ago around 27.25. I think those are those key support levels you want to pay attention to. If you are bullish, if you're positioned for further upside, those are the levels at which you might want to start to revisit how you're thinking. And also remember the RSI's topped out so far around 60, which is pretty classic for a bear market phase. But again, as long as we continue to make higher highs and higher lows, in case I haven't said it enough, the market is in an uptrend. That is not opinion. That is fact. That's the definition of an uptrend from Charles Dow. In terms of themes, it was healthcare and technology really driving things higher, followed by utilities and real estate. So as a reminder, don't ever think of a market outlook and then make a sector bet based on your outlook. Always look at the sector charts, because you'll have a situation like this with stocks going higher and utilities really being part of that up move, followed by real estate. Financials, which you'd argue you'd want to see at the top of the list on a positive day, actually was the only of the 11 S&P sectors finishing down on the day. Energy was flat. Consumer staples was near the bottom, and consumer staples had been at the bottom. I remember, I feel like earlier in the day before coming off a little bit. So we continue to have this rotation away from financials. We looked yesterday at the chart of technology versus financials, and financials have just been such a chronic underperformer. I tweeted earlier today, it would be hard pressed for me from a technical perspective to want to own a big bank versus a big technology stock until you see that ratio reverse, XLF versus XLK. It's just been in a downtrend for a long time, not just with the market sell-off, but even before that. In terms of some individual names, we're not going to get into a ton of individual stocks today, so I just want to highlight some of the ones on the move. We did have a changing of the guard a little bit on our scooter rankings. Regeneron having a nice gap higher, testing previous resistance around 575. So Regeneron's back to being the number one stock in our scooter rankings, followed by Newmont Mining, which made a new closing high today. So it's interesting, making a new high, but beaten by Regeneron very quickly. But you also have some other names in here that are probably familiar. MSCI, which has been a rare bright spot within financials, market access, MKTX as well, up in the top there. And it's funny, even something like Clorox, which is in a sector that has been struggling, CLX still making new closing highs, so in a pretty decent uptrend. In terms of gaps higher, IPGP is part of that, the healthcare sector. Healthcare up pretty big today, and IPGP, one of the biggest gainer in our scooter rankings. But you also see some other familiar names, CBOE, which is in that same group with some of the MSCI and others, with some of the stocks on the left side. In terms of the big losers, you're going to see Norwegian Cruise Lines down significantly, 22%, Royal Caribbean down 10%. So the cruise lines, travel stocks really got dinged today. CCL on the list as well. So these are biggest losers in the S&P just in terms of overall percent turns. And within the industry groups, just to point out, home builders continue to actually have some pretty decent patterns emerging. I was reading an article earlier today about home prices, and demand is down, but supply is down as well. And so there's limited supply because people are staying home and not necessarily selling their house when they would otherwise. But again, just looking at the charts, the home builders actually holding up pretty nicely. You also notice gold miners and mining stocks up on the top as well. But the number one industry group, transportation services. And again, some of those transportation stocks have really had a tough go of things, but for one day at least at the top of the return list. That's our market recap for today. We're going to take a quick commercial break. Back with my guest, Samantha LaDuc. We'll see you in a minute. Hello, everyone. Welcome back to the show. I'm your host, Dave Keller, here at StockCharts.com. I want to thank you guys so much for watching our show, supporting us, and sending in your questions. We're going to get to our mailbag segment a little later. So if you have not done so recently, just shoot us a question. The Final Bar at StockCharts.com via email or on Twitter at Final Bar SCTV. We'll capture all of those and hopefully answer one of your questions in an upcoming mailbag segment. I want to bring on my guest. Happy to have Samantha LaDuc back on the show joining us. Samantha, welcome back.
Thank you so much.
You sent a couple charts ahead of time, which I appreciate. You tend to use StockCharts. I think you're one of those people that uses our platform better than I do. So well done on that. And chart number one is looking at the U.S. dollar. We mentioned earlier just what the dollar had been doing. What is this showing you about the long-term trends here?
Well, first, I want to back up and figure out why I have even this chart, since it's been going kind of horizontal and the Fed, it's in its best interest to keep it that way versus vertical. But big picture, I'm with you, David. I think we are still in a bear market. And I did suggest to clients back in March that this might be a multi-month process of digesting these outsized, the outsized downdraft in February, March. We're going to have both rallies and failures. And so far, we've only seen the big April bear market rally. So as we enter into May, the famous adage of sell in May comes to mind. And then I look at the dollar as it makes the weather. And this past March, we had an outsized standard deviation move that was quickly pushed back down after Fed intervention. But that intervention was also outsized. They needed to break the back of the dollar bull. And it was $8.5 trillion in disaster relief coordinated by the Fed, Treasury, Congress, and so on. So why does it come up now in my radar? It looks bullish first and foremost. And yes, this is a great chart by StockCharts that I can kind of manipulate and put some funky little indicators down at the bottom where you can see there's kind of a 5-year theme. The past 3 times we've had a strong dollar continuation rally. And recently it's kind of funky. It crossed like it was going to go down and then it went back up again. So now we're breaking out. And even though we're in this kind of chop and sideways and, tussle, if you will, with the Fed, to keep it down, I think it's going to get away from it, the Fed meaning. And that's in large part the macro backdrop, the US dollar liquidity shortage. It's a real thing. It's a real problem. And also, the other currencies look weak in comparison, namely the euro. That's timely because of today's ruling by Germany's Constitutional Court that the ECB needs to show bond buying prior to the virus was justified. So that puts some pressure on the euro today.
Mm.
The point that I think also kind of brings to bear why this dollar matters now, why do I think something's going to happen now, was really fueled by Trump last week. No sooner did Powell, after the FOMC meeting, finish preaching about, these infinite Fed programs and bond buying and confidence in the US, did Trump the very next day come out and escalate the China trade war with threats of tariffs and what have you. And exactly at that moment, the dollar won USD CNH spiked, and it has stayed elevated and it is intonating it's breaking out. So as that rises, it's also putting a bid in the dollar. So we've got some safe haven plays here, not just, Treasury gold, dollar, but also yen. And I'm looking at this macro backdrop of US dollar liquidity shortage, the Trump tariff threats and trade war escalation, not to mention the chart. The chart is looking bullish to me.
Now, when you talk about the strong dollar and potentially how that evolves, you have to think about what that means for U.S. stocks versus non-U.S. stocks. You shared a chart of the EZU as your second one. How does the dollar strength relate to what you're seeing here?
Well, this EZU is on a monthly. So big picture, I was just pulling back again with this thesis of dollar higher, euro lower. EZU on a monthly for those who are trend traders, okay, not necessarily anything we're reviewing on a day-to-day, is as you can see, technically speaking, has had 3 times was a charm as far as a bounce on that green trend line. And it has since not only rolled over, but tried to retest the breakout of the red line around 31.72 and failed. And it is also intonating a rollover. And so why that matters, emerging markets also are equity markets, the dollar rising, the euro falling. I'm looking at this as a situation where Fed has it, quote unquote, under control, meaning the dollar shortage, as a control loop. So it's when the dollar gets pushed up, the Fed intervention pushes it down, but there's a reason we need to kind of maintain an orderly financial system, and that's the incentive, if you will. But if the euro gets away, if the yuan in its devaluation gets away, the dollar is going, or equities obviously come under pressure, the dollar catches a bid, and that puts even more pressure on a downward slope to the euro and the Eurozone chart. Otherwise, what happens with emerging markets when the dollar starts to spike. They get a little panic stricken and volatility enters, and volatility reprices everything.
It's 2 great charts and a great thesis. I love how you explained starting with the dollar, getting into European equities here. We only have about 30 seconds left, Samantha, but you made a comment about right at the beginning about the seasonality, right? Sell in May and go away. We're in that seasonally weakest part of the year. Can you just take a second? And I mean, how do you think about something like that, a seasonal trend in this sort of, what feels like a, once in a generation sort of crazy period? Do seasonal trends like that matter anymore? Or is there something else you would use to validate? How does that weigh into your mosaic looking at all the charts?
I honestly, nothing we have seen before with 22% of the American labor force unemployed, right? 36 million people out of work, and the Treasury just borrowed another $3 trillion this quarter on top of 1.3 billion the entire last year. So there's not anything normal and seasonal about that. Having said that, we do have typically gold that kind of pulls down into summer months, and a dollar is typically strengthened. I'm going with that theme. I really am. I also, because of that, am more bearish than bullish. And only today, this is actually just today in my live trading room, I'm like, okay, we've hit this a few times. Internally, I see more distribution than accumulation in volume. And more importantly, the dollar. If it gets too strong, liquidity dries up, foreigners become forced sellers. If the market gets too weak, money flows out of stocks and into dollars. So I'm going with that as a seasonality trade, dollar higher.
It's a fantastic take. Samantha, thank you so much for coming on the show. Hope you stay safe, and I'd love to have you back on again soon, all right?
Thank you. Anytime.
Well, Samantha LaDuc from LaDuc Trading. It's such a great, approach thinking about the big picture, the macro, which is why I love having people like Samantha on, thinking about the dollar. And I feel like we get so caught up in all these themes that we're breaking down. If you don't look at the dollar enough, if you don't think about the currency impact, how it relates to all these themes that are floating around, you're selling yourself short just a little bit. So a great take there on the U.S. dollar stability. We need to move on to our final bar mailbag. As you know, we love to ask you questions about how you're thinking, what questions you're running into as you go through your routine, analyzing the charts. And want to start out with a poll. We actually asked you not too long ago, which two of these stock charts features do you use regularly? The market summary page, the sector summary page, the industry summary page, and your dashboard. I'm not surprised if our viewers are using our dashboard because I use it all the time. I'm probably showing you all the ways that I pay attention to, and hopefully you're finding some ways that you can use this page. I sort of think of it as the homepage on StockCharts. The market summary, the sector summary, both actually received plenty of votes as well, and I could see that being the case. It's always good to focus there. Only 9% of you said you use the industry summary page. So I just want to take a moment, if you have not looked at that. If you click on charts and tools, it's right up here in the top of our website. If you look down the right side, and down the middle, these are all the different sort of preset reports and visualizations that we've created for you. There are a lot of capabilities on here that I find our users are not taking advantage of. The industry summary is a really good way of seeing each sector and then looking at the industry groups that make up that sector. You can do the chart view, which allows you to flip through the charts very quickly on the left. And I would encourage you to focus on that relative strength line, which gives you a real quick sense of how things are performing relative to one another. And if you don't know, my chart might look a little different from yours. Here at the top, you can customize what chart you use. So I would encourage you to incorporate relative strength onto this view because it shows you going through each sector. Internet stocks within communication services doing so well, fixed line telecoms underperforming, and getting that differentiation within each sector can really superpower your ability to identify stocks on the move. So thanks for answering the poll question. Thanks for giving us your feedback. We have a new poll question up there, I think already. So get to it. Next question in the final bar mailbag. Can you imagine us getting to a triangle shape as drawn? And I hope you don't mind. Actually, you very kindly sent me a snapshot of the paper with your notes drawn in there, and I'm just going to use this. So here's the thing. Could I see this becoming a triangle? I could see it becoming a triangle. What I would encourage you not to do, though, is consider this a triangle yet. And if you look, you have connected the peak from February. You've connected last week's into this week's peak, and that is a valid trend line as a top, I would argue. On the bottom, though, you've drawn a trend line that's connecting one point to nothing else. Remember, one point does not make a line. You have to connect a series of points. And what really marks a classic triangle pattern is this pattern of higher lows and lower highs where they converge. There is each one of those boundaries is tested a number of times. And a triangle pattern, if it's a true triangle pattern, usually capitulates around 2/3 to 3/4 of the way through, says John Murphy. Was one of the first, might have been the first book I ever read on technical analysis. So this one does not look like a triangle. And I think the way you can tell is if you take your lines off, it doesn't visually appear to be much of a triangle either. It appears more like a V pattern, a downtrend, and then an uptrend. I think the trend line connecting the lows, though, is very important. So I could see it becoming this sort of pattern, but we as humans tend to see way more patterns than are actually there. So I would be careful. I would be cautious about declaring something like that a triangle before it's actually baked through. Question number 2, I was looking at my chart of participation by institutions on this link, which I'm showing you now. I was finding it interesting. There's a higher participation by institutions near the possible top of the bear market rally. What insight would you have on this? So this is actually using the NAAIM Exposure Index. If you're not familiar with that, it's exclamation point NAAIM. It's a National Association, by butchering the name of this, of investment managers, I think. But it's basically institutions and what percent they're allocated to equities. It's a great way to measure whether or not institutional money managers, big money managers, are in the market or not. What this is showing you is their exposure was really low, obviously at the market low, which is pretty consistent. They've now piled back into it. So the question was, what does this mean that a bear market rally, all of a sudden it's 80% back in equities? And I would say, listen, the challenge with this environment is if you're an institutional money manager, you have a career risk with not owning stocks. So you have to get into this sort of market, especially as it's making swing highs and keeps making higher highs and higher lows. That's not an option. I think the gap here, I think, is concerning. I don't know how you wouldn't need to own stocks at this point if you're managing a big fund, just because of how far and how strong things have rallied and what's been leading. It's been the big cap tech names, which are huge weights in your benchmark. So you don't have a choice whether or not to own it. So I'm not surprised that the exposure is strong. I wouldn't necessarily see that as a good or a bad thing. I think that's more a descriptive indicator telling you how much the market has come up and how much institutions have to own it. That's how I would describe that. Third question: it's difficult to catch a top due to the huge, difficult to head to the huge drop in momentum oscillators, which skews the indicator. Yep, I'm summarizing here just for the case of time. This was the chart you sent it to, and to paraphrase, basically said this is a MACD, daily MACD on the S&P 500, and because of the huge sell-off, the huge rally, it skewed a lot of indicators, and that's totally true. So a lot of indicators like MACD went to extreme lows, or PPO, extreme lows they had not been in a long time because the trend was so strong and so quick. So I think a lot of indicators are still sort of right sizing, still sort of adapting back to sort of a quote unquote normal trend. Your question in particular was that the MACD or the PPO is at such a high level relative to previous peaks. So, is that reasonable to expect a sell-off because of that? And also, how big of a retest could we have because the MACD or the PPO is so high? So to answer those two questions separately, I don't put a lot of weight in where the MACD is at relative to where it's been, only because the MACD, the PPO are not bounded indicators, meaning it can keep going way higher. It can go way lower than it has been. It is not range bound. RSI is range bound. It goes from 0 to 100 by math. So you can't go outside of it. So you can look at historical highs and lows with a little better. I'm more looking at where it is relative to the zero line. The fact that it's far from the zero line, all I think that tells you is if we do get a sell signal, I think it's a really key sell signal. Buy and sell signals that happen near the zero line are relatively inconsequential. When they are far away from the zero line, that's when it's very meaningful. This is why the daily MACD turned positive sort of end of March, has remained positive. If and when we get a downturn, I think that would, sort of make an argument for the continuation of this bear market phase and another leg down. We haven't quite had it yet. You can see the histograms come off a little bit, showing you the slowing of pace of this bear market rally. But that's how I would view these. Just because it's so high does not mean it can't go much lower as the market evolves. I don't think that's necessarily an issue here. Those are all the questions we have time for. There's some fantastic questions. Listen, all three of those you included charts, which I really appreciate. We'll get to more of them later this week. We need to finish our show, folks, with the 3 and 3, 3 charts, 3 minutes. Here we go. Chart number 1 is the Russell 2000 ETF. I'm always looking for guideposts, charts to look at besides just the S&P to try to get some validation, some confirmation of what we're seeing. Now, small caps have been underperforming for a while. They just made a relative breakout here at the end of last month, making a new 1-month high, but it's come off a little bit. I'm looking at a trend line from the March and April lows, and I'm looking to see if and when that breaks. The S&P is back up here at the 61.8% retracement. The small cap index, the IWM, is actually retesting that 38.2% retracement level. So we're right at a confluence of support. And I think a breakdown below that trend line, below the 38.2% level, would suggest the next leg down. We haven't seen it yet. Second is looking at breadth in the form of the percent of stocks above their 50-day moving average. We were at 75 just not too long ago. We're down to 55, which means a full 20% of stocks have rotated back below their 50-day. That shows you how a lot of names starting to rotate lower. Even though the broad S&P has not done it, it's happening with individual stocks. And then finally, our last chart, to build on what my guest Samantha LaDuc was talking about, looking at the weakness in European stocks, the strength of the dollar. I think this ratio we look at, which is the S&P versus ACWI, All Country World Index. This is U.S. versus the entire world, making a new relative high again this week, showing you U.S. stocks continue to work. And again, that's a dollar strength story. That's a lot of different inputs. But again, until that ratio really starts to turn, starts to make lower highs, I think you have to assume a further dominance of U.S. stocks versus non-U.S. And folks, that's our show for today. Thank you so much for joining us every weekday for the Final Bar. Special thanks to my guest, Samantha LaDuc, for joining us today. For StockCharts.com in Redmond, Washington, this is Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.